Hi, Al Srijit here. Welcome to my YouTube channel, New Wealth Insights. This is first among a list of videos on investing in equities, real estate, bonds, mutual funds, etc. So we will talk about uh, emerging economies like India, Brazil, China, and we will talk about investing opportunities in US and other parts of the world too. So this video is talking about the various business models which is around the world, and in which how we can invest our money to get a better profit for that. When it comes to equity, or when it comes to stock market, or like when we hear about investing any of the aspects, we will hear about trading too. Investing and trading both are both are there. So let's start with the cricketing analogy here. So trading is a one day cricket match, while investing is a test cricket which spans for 5 days. So investing in equity means like you are owning the business. When you look around the world, we have great companies like Apple, Microsoft, Procter and Gamble, Johnson and Johnson, which you use as every day in your life. So if you consider those business, you if you appreciate this as a great business, you want to be part of that business. So the one way is like invest in those companies, like buy the shares of those companies in which you believe or which you saw around the world every day. So when you buy those companies, or like or though when you own those businesses, that where your ability to gain more profits are you can earn profit through that way. It's an investing is an effective way to put your money to work and potentially build wealth. So however, when you when you consider trading is most of the times it's a speculation of the future price of an asset or a commodity. It can be based on some non information, and sometimes it will be based on heuristics, etc. It is Trading is inherently complex than investing, as time also plays its own role. So whenever you do trading, you need to ensure that you are having the proper trading setup is there, you are having a proper trading strategy is there. Traders is focus on stocks technical factors and direction of the stocks, whereas investors is focus on the fundamentals of the stock and its a long term outlook. These are all two different viewpoints. I'm not saying that trading is bad and we are unable to gain profits through trading. We can also gain benefit. We can also gain income through trading. However, we need to ensure that uh, we should be knowing, are we doing investing or trading. When it comes to investing, so I thought like we'll start how the big money managers, the mutual fund managers or the hedge fund managers, is how they are managing the investment, how they are approaching their investment. So there are two types of investment approaches which is prevalent around the world. One is called top down investment and another one is called the bottom up investment. The top down investing is an investment analysis approach that involves looking at first at the macro picture of the economy, then looking at the smaller factors in finer details. Using a bottom up investment approach, a money manager will closely examine the fundamentals of the stock. They will look for the companies that they will believe perform well over the time based on such determinants as the company's management team, leadership quality, and its a debt to equity ratio, how much profit it can generate in the future. All those things they will consider. When it comes to top down investing may produce a more long term or a strategic portfolio, including more passive indexed strategies, while a bottom up approach may lead to more tactical and actively managed strategies. I thought of separating business models on multiple factors here, and we'll go through one by one. So B2B and B2C, these are two different business models in which the most of the companies are operating on. So there are some companies which directly deals with the customers. There are or like consumers, And there are some companies which will deals with the big businesses. There is a big insurance company which will get technological contracts from another big companies like Microsoft. Say that is an example of a B2B business. And if you take B2C, there are companies which is customer centric, which talks directly, which deals directly with the consumers. B2C companies always having a superior position with respect to the stock market investing. Business, they have a higher, better pricing power, and B2C companies can understand the consumer sentiment too early, as they directly deal with the consumers, and which helps them to improve their product and service qualities. And B2C companies can apply better marketing strategies through loyalty programs, businesses, etc. Apple, Costco, Netflix are an excellent examples of this B2C business model. There's another type of business model I thought about is like a capital intensive versus creative intensive. So there are some businesses which requires lot of capital, to make the products, to make the products out and sell it to customers. So this kind of a, I would prefer to avoid capital intensive stocks, as the capital intensive industries needs a high amount of high volume of production to provide an adequate return on investment. Examples for such industries are like automobile manufacturing, oil production and refining, steel production, telecommunication, transportation sectors, and others are all very capital intensive sectors. If they are unable to raise enough capital, or if they want to borrow capital from somebody to run their business, it will potentially hamper your business returns, and then it will impact your stock prices also. So finally, it may not turn out to be a good investment. And when I look through this creative intensive business models, there are businesses which uses the human knowledge and human intelligence or the creativity to generate profits. So they will be having a lot of intellectual property rights, which can deliver the business profits with less capital involvement. Yeah, there is capital involvement is there, but the products they make out of this intellectual property rights can have multiple impacts. Many software companies like Google, Adobe, Microsoft are all examples of the creative intense business models. Moving on to another, I thought like I'll divide business into another area in which how business can effectively operate on. This is called regulation. So we know government or some sort of an institutions will regulate, is doing regulations all over the world on various businesses to ensure the fairness, competitiveness, and efficiency is in place. However, when we are having excessive regulations on certain businesses, it affects the growth prospects, it impacts the efficiency of the business. So I would like to stay away from such a highly regulated businesses. Recent trade tariff related discussions and excessive regulations in tobacco companies are such examples. Yeah. Uh, when you look at this, yeah, there are companies which withstand excessive government regulations, and that was due to some of the modes around that industry. When uh, when you take the tobacco companies, there is not much competition in that particular sector of companies. So maybe only one or two places are there. So even if there is a higher amount of regulation is there, they can still succeed and survive. However, my point is like whenever there is an excessive regulation, it may impact the efficiency and the growth prospects of company. I would stay away from such a highly regulated businesses. Then I thought about uh, looking at the business through a different lens. So cyclical versus evergreen. There are some business which is like a cyclical business, which depends upon the demand and supply of the demand and supply of that products, which follows through the economic activities around the world. So cyclical stocks are the stocks which is having products or like services which depends on the overall mood of the economy. If the overall mood of the economy is good, or like the economy is growing, then it consumes uh, some products or services more than usual. So such stocks are called cyclicals. So such stocks and businesses having a problem, like when the economic activity starts slowing down, it impacts their performance, it impacts their profit margins, and it then finally it will impact their stock prices too. And there are another sets of stocks are called evergreen or defensive stocks, which will do well in both in economic downturns as well as in the economic upsurge also. The products and services from this category, this evergreen category, is required for all the times. An example of a non-cyclical stock is or like a non-cyclical commodity is toothpaste also. Whatever happens to the economy, we will still need toothpaste to brush our teeth, and we still need soap to take bath, and we need utilities to run uh, and the home appliances to get the electricity into our homes and all. So such stocks are there forever. We have stocks related to this evergreen category are Procter and Gamble, Colgate, and Palmolive, etc. So most of the cyclical stocks will falls into uh, uh, automobile sector or like a steel manufacturing. So when the economy starts slowing down, we don't need people. We there is steel consumption will be less. We are not going to build much home. So uh, we need to stay away from cyclical stocks if you want to ensure that uh, your if you want to ensure that your portfolio is not impacted when a particular commodity or a business is undergoing through its cyclical nature of that business. And then I thought of separating the business based on a simple theme called simple versus complex business model. A simple business model can be understood as company's business plan to generate revenues through products and services which can be easily understood and predictable. Uh, the legendary investor Warren Buffett is a great proclaimer of a simple business model. His investment in Coca Cola, Wells Fargo, Bank of America, many other businesses are based on this simple tenet. So when you think about Coca Cola, they are making only a certain type of products, which is like which everybody can easily understand what they are doing. So such a businesses, even though when you look it as a simple business model, it's a powerful business model in terms of its predictability and in terms of its wide economic mode, and it can provide a huge return potential to the business owners as well as to the stock owners. When the business model gets complicated, it is difficult for investors to calculate the value of the business as well as we are unable to predict the cash flows. I look at this way: when you are having n number of factors that are affecting your business, if one of those factors is not working or not working in the way we are expecting, it will impact your business revenues, and it's very difficult for retail investors to find out the intrinsic value, and then we are unable to predict the cash flow. So it's very difficult to build an investment hypothesis around that. And so I would just like to stay away from such complicated business models, and stick to some simple business which can provide huge business opportunities. Yep. That's it with respect to this separation of the business models. Then I thought of putting up some investment philosophy through the codes here, and uh, that's all about investing in equity. If you are able to choose your investment through in right in business sectors, then you can easily reap lot of wealth, lot of income through that. Yep. Thanks for watching my YouTube video, and stay tuned for more videos on this on stock market investing. Thanks all. Thank you.